This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Fidelity's shocking move leaves customers outright stunned. We'll show you what Fidelity just did and why many of its customers are now questioning Fidelity's ability to manage their money. Plus, China just shocked the markets with an unprecedented move. We'll show you why Beijing's latest attempt to prop up the markets will not work. And the Bureau of Labor Statistics just released a red-hot non-farm payroll report, which now suggests that perhaps the Biden administration is cooking the books. We're going to show you what the truth is behind this report, why it's bad news for the Biden administration, and why it means the U.S. economy perhaps is now months away from a big downward spiral. Now let's head over to Bloomberg, where he picked today's story up with a headline as Fidelity lowers the value of stake in Musk's X by a whopping 5.7% in February. And this has customers outright shocked because bets against Elon Musk have not paid out for many investors. And here you can see Fidelity is cutting its position. And when we look, it makes absolutely no sense. Fidelity, which gained a stake in X by helping Musk complete its $44 billion purchase in October of 2022, valued the position at $5.28 million as of February 29th. A month earlier, it was worth $5.6 million. But the overall value of the blue chip growth fund's X stake has fallen 73% since Musk's purchase, suggesting a similar drop in value of the company because the fund hasn't disclosed any change in its position. So the question here is, what is Fidelity up to? Because when we look at the returns of its blue chip growth fund that owns this position, well, it's beating its category. It's beating its peers. And this makes absolutely no sense because when you're ahead in your position, you can afford to keep some laggards. Many of his customers now are questioning, how can you bet against Musk? The question is, what would you do if you're a fund manager of Fidelity? Would you cut and run, or would you hold on a big bet on Musk? But someone who's betting big on their markets is Beijing. I'll show you why those bets are going to fall flat. As China's fund projection team bought $6.8 billion in stocks in the second half of 2023, the so-called national team bought at least 49 billion yuan worth of onshore exchange-traded funds in the 6 months through December 31st. The amount exceeds an estimate of 28 billion yuan by Bloomberg. This is a fact based on the latest filings made for the first time since state-backed funds announced the purchases last year. Now, this is something that many investors believe is incredibly bullish. Now, why would China come in and buy its equity markets? Well, there's one simple reason. They're down, and down a lot. You can go back to the recent peak way back here, and you can see their equity markets are down 55%. Compare that to the U.S. markets, which are up. And the problem here is there's nothing that seems to be keeping their market from going down. And that is dangerous because when equity markets go down, consumers lose confidence, they quit spending. But there's also a secondary problem. A lot of companies pledge their stocks to get loans. Well, if those values go down, they have to make a margin call. If they don't have the cash, well, there goes your banks. And purchases by state institutions such as sovereign wealth funds, and which were active in early part of 2024, slowed in March as the market rebounded. The CSI 300 ended the month little change after a 9.4% surge in February that was the biggest since November 2022. Now, you might remember back then we showed our colleagues how to take advantage of that. If you were a subscriber to our reports, we even put it on our Sunday show and said, look, you can make money, and many of you did. And here's another one. You want to make money trading stocks? We show you how to do it, giving you the premium reports. This is as of close of yesterday. Now, keep in mind, the market had a big pullback. This is a recent trade. We like to say we give you 30 days for free. Why? Because we know you'll pay for months, if not years, of your reports. Here's one back on March 7th, our CTA report. This thing looks at machine positioning. Now, every Sunday we talk about how machines move massive amounts of money in the market. We show you how to get in front of them so you can make money. This trade up 7.05% after yesterday's close, rallying hard in today's market. That number going up. Again, the cost to report for a year is $330. These people are all in the black. There's 30 days. put you in position A. Maybe you trade technicals. Well, our Momentum Time Pro report, it does that too, but it does it better. Instead of you getting in late and out early, we show you how to get in at appropriate time, hold on to the trade, make more money. Here's what our reports did. They said buy here, and now you're up here. This thing is rallying today, looking to break out. This is uranium. And again, 2 reports. We give you the report every day. We give you a video on how to trade it. We show you the signals. We tell you what to do. There's our CTA. There's our Momentum Time Pro. And again, links in the description below. Why 30 days? My friends gives you 7. You can't make money in 7 days. But we can make you money in 30 days. Try it and find out, because here's the deal with China. Again, we showed you how to make money on this China trade, but the question is, why is buying billions of dollars in ETF not working? It's simple. It has everything to do with the economy. Here we're going to look at some U.S. data of commercial industrial lending. This shown in blue. This is on a year-over-year rate of change and based on the most weekly data available. And look at this. It's against the U.S. equity market. Now, the Wilshire 5000, this is indeed the total U.S. stock market. So when you see decelerations in bank lending, well, that means the equity markets are coming down. It makes sense, because what it's telling you is there isn't enough money being created by the banking system to support equity prices. And that's when you see these contractions, well, you usually get a pretty steep drop in the equity markets. And you can see that during the dot-com bubble, the global financial crisis, and even here, coming out of 2015, 2016, you notice deceleration in bank credit. We saw that slowdown in the equity markets. It happened again going into the pandemic. But look what's different now. For the first time in history, we have a contraction in bank credit, and the world is piling into U.S. stocks. You can only imagine at some point this will reverse. The good thing is we give you the tools to find the opportunities, whether it's by the machine positioning, whether it's by the technicals. You don't have to ride this thing down. We show you all the signals to give you the edge. But China, see, they understand some of this, because look at what they're doing. They're trying to create credit as they ease car loan rules and new bid to boost consumption. And that's really what makes sense, because in a debt-based economy, you don't need to come in and buy stocks in the case of what Beijing's doing here, because it will not work. As long as they continue to see a contraction in their economy and a contraction in credit, they can buy all the stocks they want and it won't work. What they need to do is get people out borrowing, get money moving through their economy, and creating new opportunities. The new rules follow pledge last month from the head of National Financial Regulatory Administration to promote consumption by making it easier to get car loans. China's been struggling to reignite weak consumer sentiment as a property market slump and gloomy jobs outlook hurts household spending and has made the trading in of consumer goods like cars a major policy to boost the economy in the year ahead. And that is more of a smart move, is what can you do to get people to spend money? But one of the challenges that China is facing, and we're going to see this in the payroll report when we get into the U.S. data, is the fact that these unclear that these relaxed loan rules will be enough to spur a meaningful increase in demand for big ticket items like cars. And why is that? Well, if consumers do not see opportunity in their future, if they do not believe that things are going to get better, well, they're not going to spend money. And that's the thing, what we see here with Chinese consumers. You can relax loan rules. You can do lots of things to make it easier to get a loan. But if they do not see economic prosperity, they're not going to borrow. And that is bad news for China's economy, particularly the EV market, the world's biggest, is set to slow for a second time this year amid weakening economic outlook. And there's really the key point, is whether you look at this, is the economy is getting weaker around the world, and that means consumers are not spending. Now, this puts into a big question, and wait a minute, the U.S., the labor market is strong and robust. We continue to hear that from the Biden administration. We continue to hear that from the political elites like the Federal Reserve, that everything in the U.S. is booming. Look at the stock market. But yet when we get underneath this payroll report, we start to see a lot of red flags that perhaps the U.S. economy is nowhere near as good as the headline number suggests. As U.S. jobs roar again, as payrolls jump 303,000 and unemployment drops. Now, this is great news. Again, if you're President Biden heading to re-election, this is really what you want to see is, look, the economy is booming. You take this, of course, to voters and say, look, under my administration, things got better. That's exactly what you want to see to get re-elected. From the Fed's perspective, well, that means no rate cuts coming soon. Of course, we know that going to election, the Biden administration would love to see a couple rate cuts. Maybe we will get them later, but just based on this payroll report, that's not likely. It's going to take some other factors to drive the Fed to cut. That will come, but it won't be a good thing for the elections, at least not for the Biden administration, as the U.S. labor market appears to be strengthening, not slowing, and risk delaying Fed easing. Now, the question is, where is this number coming from? Why are we getting these big prints in the non-farm payroll report? Well, we notably have gotten some backward revisions to the downside. The question here is this motivation by the Biden administration instructing the Bureau of Labor Statistics to push this number up, to give people opportunity in terms of thinking that, yes, there are jobs out there? Well, it's not quite that at all. The labor market has been the stalwart of the U.S. economy, giving Americans the wherewithal to keep spending. But there's an issue here, because what have we been talking about in the last several shows is a continued deceleration in demand. In fact, yesterday we talked about demand at automakers here in the U.S. down. You've seen reports from Tesla saying demand for autos is also down. What did we see with Ulta on the services side and beauty products? Demand is down. So we continue to see demand is falling against rising payroll. So that tells us on the onset something here just isn't making sense. And is it just an issue of high prices and borrowing costs? Well, it could be. And while Fed officials have flagged moderation in job gains over the past year as a possible precursor to interest rate cuts, Friday's data may raise questions over the extent of that cooling and its implications for inflation. Of course, we note the Fed loves to believe that jobs lead to inflation, which isn't necessarily true at all, but this will at least, for the next meeting, keep them on ice. But let's head over to Zero Hedge for a moment, because that number was not only hotter than last month, revised number of 270,000, was also the highest Wall Street estimate of 290, as shown below. This suggests that nobody could have predicted this number, which doesn't make any sense. Usually Wall Street's fairly accurate here. As the March number, which will likely be revised lower next month. Again, no one cares about the revisions. They care about the initial print. It follows two downward revisions, follows a 5,000 downward revision to February and a 27,000 upward revision to January. So the bottom line here is, despite the fact that we've seen revisions and we're likely to see some downward revisions here, the payroll report continues to print big blockbuster numbers. And this is putting a lot of question in, why are we continuing to see a deceleration in demand? Is this an issue with, of course, the BLS cooking the books, or is there another factor here? Let's take a look at the manufacturing sector here. Let's go to the Philly Fed. This is a diffusion index for the employment. Now, anytime that blue line is under the horizontal black line, that means that the Philly Fed is saying that employment is contracting, people are losing their jobs. Now, we overlaid the non-farm payroll report. Now, we have to do this on a year-over-year rate of change. The pandemic really skews this where we can't see it on the charts, but what you see is as manufacturing lays off, you see a deceleration in the year-over-year rate of change in the non-farm payroll report. It's very, very clear. There are a couple cases where you don't see it, and one of those is now, and this leads us maybe to the first question of, is there something odd in this report? Why are we seeing jobs created, but we're not seeing it turn into consumption? Well, part of the reason could be that these are now multiple job holders hitting the market, people with full-time jobs getting part-time jobs, because when we look at the weekly unemployment claims, we note that continued claims are sitting around 1.8 to 1.9 million, and that's fairly consistent with non-farm payroll running on the current year-over-year rate of growth. In fact, you notice the two are somewhat mirrors here of each other. So part of this could simply be explained by people are losing their job and picking up another part-time job. They're not getting full employment. Maybe someone who is fully employed is picking up a part-time job on the side to make ends meet. Those start to make sense in a lot of ways. But there's another factor that we're not seeing just yet. An aggregate measure of weekly payrolls, which provides a broader reading of changes in earnings, hours of employment, rose a whopping 0.8%, matching the biggest monthly increase. Here you can see average hourly earnings came in at 0.3%. That actually missing kind of to the downside as we see a continued deceleration in wages. And now we're starting to get to the heart of this payroll report, because what do we see? Total compensation, this shown in blue, this form of average hourly earnings multiplied by average weekly hours of production of non-supervisory employees, this shown in blue, shows a decelerating trend, means that as it goes down, well, payrolls will go down. The challenge right now historically is total compensation growth, well, is actually fairly high. So it kind of makes a sense here that we're seeing the payroll numbers hold around these elevated levels. Again, I think this is more coming back to multiple job holders showing up, and perhaps we're even seeing some of these people that are losing their full-time jobs coming back into the labor market, as the household survey also publishes its own measure of employment, which surged nearly 500,000 in March after declining the prior 3 months. So there is a little bounce back here, as many economists have discounted the recent weakness in this metric, given that other indicators remain strong, such as unemployment claims and consumer spending. But we've noted that consumer spending here continues to weaken. And now that we're getting to the real heart of this payroll report, is my claim that we're seeing multiple job holders, and as you're about to see, that people are indeed running out of money. Increased participation may also be helping alleviate wage pressures. The survey of establishments showed that the average hourly earnings rose 0.3% from February and 4.1% from a year ago, the slowest annual pace of mid-2021. So there is a factor here. We're seeing more participation in the labor market, and that is putting downward pressure on wages as more people apply for the same job. That means employers don't have to give out as big of raises. And so now when we look at total compensation, still shown in blue, against the labor force participation rate shown in red, and this is the percentage of age-eligible people that are participating in the workforce. And what you notice is this trend is rising right now. Well, typically when we see a deceleration in total compensation, well, you see people kind of initially come back into the workforce. And it makes a lot of sense when the households see their income start to shrink relative to inflation. Somebody goes back to work, picks up a second job, and you see that labor force participation rate rise. Now let's look at it. Now, what do we see today? A big decline in total compensation. People are coming back into the workforce. Why? This is a factor of inflation and households not being able to keep up with not only the cost of goods, but the cost of debt service. And we see that evidence here as we didn't zoom in to average hourly earnings. Now keep in mind, this is what the government tells us is the only thing that matters. People are getting big weight raises, but notably look at this. As you see average hourly earnings continue to decelerate in a big way, look at this. People coming back into the workforce. That tells you what's going on with the economy. Why are we not seeing a big increase in demand? It's because people are falling further and further behind. They need the money. They're heading back in there. And notably, we saw hours worked pick up last month. And again, as hours work goes down, labor force participation rate goes up. What this tells me is the labor market isn't as strong as that headline number suggests at all. It's telling us that things are getting weaker because as more people go back to work, we're not seeing an increase in consumption. That's a red flag. It tells us debt levels are too high, tells us debt service costs are too high, and the costs of goods are way too high. That does not bode well for, of course, the Biden administration heading into the November elections. If we don't see demand pick up, well, in a meaningful way, that means, of course, more people will be back on the unemployment line. But it makes sense now, and manufacturers and everyone is seeing this increase in employment. They think demand is coming. They're stocking up, and what they're going to find out is people are struggling and things are financially getting far worse. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.